All right. So in terms of the cost, there are two components, two large components. We'll cover the first component today, and then the second component is more of the quantitative component. So there's a qualitative and quantitative. And overall, right, the idea of the cost is that to give you tools in order for you to value a company. So in the following slides, you'll see a lot of different tools, a lot of different frameworks and things that we're going to use. Basically, they're all tools. And the idea is that you're not supposed to use all of the tools. You are supposed to just know that they exist. So when you value a company, you can think like, oh, okay, maybe I should use these tools, or maybe I should use that one. This is better. And that's the idea of it. And so today we'll cover all the qualitative tools, which I believe is not new to most of you all. And then in the subsequent 5 lectures, that's where we'll cover the quantitative tools, which we will see can become more and more complex in terms of mathematics. And so we'll cover some foundation on time value of money today as well. We just do a recap, but hopefully, for those who are quite good at it already, this will be a walk in the park for you. All right, so that's the idea of the entire course, basically just to understand how do you value equity or a company. At this point in time, any questions? No. All right. Okay, so these are some of the course readings, the lecture notes. So something to take note is that if you have accessed the T03 tutorial site, you'll notice that there are like a full set of lecture notes. I encourage you to use those lecture notes because we'll be using them during this lecture or during all lectures. And then I actually uploaded some changes to the notes on the weekend. So the last weekend that just passed, I think it's on a Saturday. So in case you have downloaded the notes like 2 weeks ago, you should download the new sets. Anyway, the idea is that I just reshuffle a bit of slides. There are no new materials. In the lecture notes, you also realize that compared to your other peers, my lecture notes are like a lot thicker, a lot more slides. The idea being that I include a lot of details. So hopefully, with the lecture notes, it should be enough for whatever assessment that you have, and you don't have to refer to your textbook or study guide, even though I encourage you to do it in case you have any doubts. All right. So not worry that, if your classmates in other class, like, oh, they only have like 20 slides and then we have like 120 slides. But you just know that there are a lot more examples, and I also include a lot of practice. So as you know, this semester is the first semester we are starting the 12 weeks. So there are gap weeks in between lectures. So if you notice for lecture notes 2, 3, 4, 5, and 6, there are actually a lot of like self-practice questions, and I've clear answers as well. So you'll be able to practice during the so-called break weeks, where you are supposed to more like self-study and all, right? So I've included those. That's why the number of slides has like exploded compared to the peers. In terms of some administrative deadlines and all, I believe you have seen this. I mean, being year 3, I think this is no big difference. Something I'd like to cover is the class participation. So this part, usually I like to be very transparent. So everyone in the evening class, as you might already know, get a 50%, right? So if you want the other 50%, meaning the 5%, is generally just participate in class, ask questions. I encourage you to unmute yourself if you do have any questions, or even just type in a group chat, right? And then we can address the questions as we go along the lectures, right? So that's for class part. So I repeat again, everyone usually everyone will get 50%. The other 50% of the class part would be just based on how much you participate. Any questions so far? Okay. In terms of financial calculator Excel, we'll be using Excel most of the time, or actually, in fact, all the time. We'll not be using a financial calculator. So in case, you did more financial calculator in the past, like year 1, year 2 mods, if you want to use it, feel free to do it. But I encourage you to use the Excel now, because it'll be a lot easier to use Excel, especially if you get more complex calculations. And so all examples I'll be using Excel to just show you. All right. So, that's just a short introduction to the course. Now let's jump straight into valuation and the course content. So, again, before we start the actual lecture per se for today, what the idea of it is that it is to give you tools to value a company qualitatively, right? So we are looking at qualitative tools. And then the next few lectures, we'll look at quantitative tools. And I want to repeat again that you do not really need to memorize. Like, for example, we are covering what is valuation. You do not need to know like what is valuation. There'll be never a question asking you that. It is more about at the end of the day asking you to value a equity, right? And so you need to basically understand the various tools, and then we'll go along and I'll explain along the way. All right. Okay, so let's jump straight into the first slide. When we talk about valuation, the idea of it is that we want to find out what's the actual value of the firm, right? Because what the market price of the firm might not actually be the actual value. So, we have various ways of doing it, and there are various reasons why we want to actually value a firm. And let me just pull up my pen here. Give me a moment. Right, so there are various reasons why we might want to value a firm, and it could be due to merger acquisition, we are portfolio manager, and of course some corporate finance management kind of things like divestment, investment, etc. Nothing too important, I would say here. You can just have a look at it. It's just more, just having some background in terms of valuation. And the thing about valuation is that, like I mentioned, we want to determine what's the actual value of assets, right? So most of the time, the value of asset we see, such as the stock price on the market, is not what is the intrinsic value. And we'll talk about intrinsic value in the next slide. But it basically is not intrinsic value. And the idea of it is that there might be some, inefficiencies in the market. And because of that, we try to capitalize on the inefficiencies so that we can gain some, some money or some abnormal returns. We would like to put it that way, all right? So this is just for you to read. So basically, we want to pursue what's the true value, nothing too important. And the idea of it, like I mentioned earlier, is about intrinsic value, right, and market price. So intrinsic value and market price, if we believe this idea of an efficient market hypothesis, hope this is not new. So I think you have probably learned it in year one. So this idea of efficient market hypothesis. So the idea of this is that if the market is really efficient, then the market price and the intrinsic value should be equal, right? However, we understand from empirical evidence in the from the efficient market hypothesis that the markets tend not to be very efficient, and therefore there is some purpose or some value in actually finding out what is the intrinsic value, comparing it with the market price, and if there's some variance, we can actually capitalize on this variance and maybe earn a bit of money from that, right? So let's just try to understand more about this idea of efficient market hypothesis. Anyone still remember there are three types of kind of markets? Anyone remember that, even though I know it's in the next few slides? Okay. I think that is a bit on the economic side, right? Expansionary market. So if you recall, I'm just going to flip. Thanks for the reply, by the way. So the efficient market, there are actually three types. So I'm just going to show you quickly first. So there are actually three types of efficient market: strong form, semi-strong form, and weak form. So we'll cover them briefly. Again, I would like to say that you don't need to know what they you don't need to memorize like, oh, what is a strong form, but you need to generally know the idea of it. So in case you write in your valuation, you can say like, oh, generally the market is let's say a weak form, and therefore there's purpose in valuing, blah blah blah, and so on. So yeah, you kind of need to know the idea, but I want to repeat again, you don't need to memorize all these concepts. Okay, so the idea of efficient market is that if the market is efficient, then the stock price should be equilibrium, everything should be fair, information should be very efficient, right? So everything is like perfect. That's like a perfect market. And if that's true, basically you cannot earn any abnormal returns or excess returns that I mentioned, like earning a quick buck in a sense of, finding a stock that is undervalued and then you actually sell it and earn a quick, the so-called arbitrage profit. So the idea is that you can't do that in an efficient market. However, the efficient market, if the market is efficient, it does not imply that you cannot earn any positive returns on the stock market. So the thing is that in an efficient market, you can still earn returns, right? But you can't earn abnormal returns. And the returns that you can earn is basically how much risk you take. So if you take more risk, get more return, but you cannot earn, let's say you take a small risk, but you earn a big return. So that's abnormal. So you basically, in an efficient market, you can't earn an abnormal return, but you can still earn return. That's an important part that you need to take note of the idea of efficient market. Okay, someone has an issue with finding the slides on Canvas. So they are in the T03 tutorial group on Canvas and under module. Anyone else has issues with finding the slides? We all have the slides? Okay, perfect. All right, so in an efficient market, right, what happens is that ideally, if there is new information that is introduced in the market, so let's say it's a positive information, so let's say the price is going like this, in the efficient market, the price should immediately jump to the next level here, right? And this is an efficient market reaction. However, we know that in most of the time when there's new information could be like annual reporting, when they announce their earnings. We understand that for most of the time when there are new information is out, the market takes a bit of time to kind of adjust in the sense of, it might actually goes up slowly to the new price, or there might be an overreaction where it goes up and then the market realizes, hey, you know what, actually the information is not so positive, then it goes down again, right? So these two signals actually show that, hey, you know what, maybe the market is not truly efficient. And therefore, because of that, we have, the three forms of market that we talk about, strong form, efficient, semi-strong form, and weak form. And we'll go into some details in the next few slides. So not worry about these comments that are put here. So we'll explain this, all right? So the idea of a strong form market is that the market reflects all information. So this is important, right? All, including public and private. So, and we know that in reality in the market, if you have private information, you can actually earn some, profits from there. All right. So we definitely know that market is not strong form, but this is theoretical, right? So in this theoretically efficient market where all information, public or private, is available, then you cannot earn any kind of abnormal returns or excess returns, regardless of the type of information that you have. And so what? Because the market is super efficient, then there's no point trying to do valuation. There's no point trying to later we talk about technical analysis. There's no point doing all those things, right? You basically just hold a diversified portfolio and just get market returns, because whatever information you try to do with your fundamental analysis and technical analysis, two things that we'll be talking about in the next few slides, there's no point doing that, because the intrinsic value of the firm basically equals to the market value. So yeah, there's no point. So this is the idea of a strong form. A semi-strong form. Now, it means that the price only reflects the publicly available information. This means what? You cannot earn any abnormal returns based on public information, but you can kind of earn some profits if you have insider information. You have information that's private, right? So if you see now, maybe you notice that, hey, you know what, maybe the market is kind of the actual reality of the existing market is kind of like a semi-strong form, and you're kind of right. It tilts towards more of the semi-strong form and later the weak form. So we've got to understand that, generally for the idea of efficient market, it's a spectrum, right? So it's a market doesn't fall strictly on a semi-strong form or strictly on a weak form. or even a strong form. So if the market includes all public information, means what? If you do fundamental analysis, and the idea of fundamental analysis, which we'll cover in just a bit, is you look at the financial statement, FS financial statement, and then we see like, oh, you know what? We try to analyze the ratios and all the details, and we try to pull out some value from there, right? And say, oh, at the end of the day, the stock is undervalued and therefore you should buy. But the idea of a semi-strong form is that, hey, you know what? Because if the market is semi-strong, means that includes all available information, all available public information, and the FS is a public information, right? So there is no so-called excess return they can earn on this information. So you know what? Maybe if you realize this does not make sense, right? Because the reason why we are even learning about equity valuation is that we are using public information to value a company and try to make some short returns. So, actually, at the end of the day, maybe the market is like a weak form. A weak form means what? That the price reflects all market information. So what is market information? Market information includes like volume information. So volume traded, maybe price, stock price. If you look at some charts, there might be some charts. Later we'll have a look at some charts, and then it reflects all the charts. This is like the movement of the stock. It's a very bad move, but yeah, the movement of stock. So yeah, it reflects all kind of like a market information. And therefore, if this is true, you cannot earn abnormal return based on market information, meaning what? Technical analysis, which is something we'll just touch a bit later, but we'll cover it more in the subsequent slides. It means that technical analysis will not give you abnormal returns. So, like I mentioned earlier, empirical evidence actually suggests that market is generally more of a weak form efficiency. But I would like to highlight again, at the end of the day, a market is not, it doesn't fit into these three categories, right? Usually it's a spectrum, it kind of fits somewhere in the middle here and there. So this is a pictorial representation of the various type of markets. I want to highlight this. This is important, or this misconception here is that under the efficient market hypothesis, it does not mean that you cannot make money, right? This is very important. It doesn't mean you cannot make money. I mean, if this is true, then there's no point valuing a company anymore, right? The idea of it is that on average, usually the amount of money you make or the returns you get is proportionate to the risk that you take. So it's directly proportional. More risk you take, more returns. Less risk, less returns. And the idea of it is that this efficient market does not protect you if you do not diversify. So probably you have taken some maybe portfolio course. I'm not sure if anyone have taken it because I was teaching it last semester. But if you did take like a portfolio management course, you know that as a portfolio manager, the idea is that you have to diversify, right? And the idea of efficient market is that, yeah, okay, maybe you take, maybe let's quantify risk, right? If you take risk, level 1 risk, so one level of risk, you get one return, right? But the idea of this one risk to one return is that you will have to diversify. Imagine if you take, let's say 2 risks, right? And if you do not diversify, maybe you just get one return. So, idea of it is that you have to diversify in order to respect, or in order for the efficient market hypothesis to be respected. So, if you do not diversify, you still might actually get, you might be taking more risk, but you're getting less return. Okay. Any questions at this point in time on efficient market? Good. Okay. All right. So that's just basically the backbone of valuation again. And like I want to repeat, you don't have to memorize. Try to really like memorize all the what's a semi-strong and blah blah blah. It's more of like just having a background of these concepts, so that when you value a firm, when you write your valuation report, you can actually mention some point, right? That the market is a weak form, and therefore we are doing valuation, etc. So yeah, these are some concepts that I would like to bring in. So basically on valuation, the idea is that the market is inefficient, like what we talk about, as a weak form. Now we have known what's a weak form already, so it's kind of a weak form, and therefore there might be some mistakes in terms of intrinsic value that we covered. Intrinsic value might not be equal to the market value, and therefore that's the reason why we want to do valuation in general. Right. So this is an important slide. And these are the steps of valuation. And so I believe, at the end of the day, at the end of this course, if there's something that you need to learn, is about how do you value a firm. And I believe it's also part of your assessment criteria. And so if you want a good, reference material to actually understand what are the steps you have supposed to take to value a firm, this is a perfect slide for it. So let's cover it step by step. So we have step one. Basically what we do is that, we try to assess what is the industry. We'll later talk about, what are the firm size, the competitor, what's the growth of the industry, what are some demand, supply. So we'll talk a bit of economic kind of conditions, if you like to put it that way. We'll talk about what's the relative competitive positioning, competency of the management. And then this is step one, right? So we want to try to understand what's the company first. And then after that, we try to use various techniques. So there are two techniques that we'll mostly cover: top-down approach or the bottom-up approach. And then we'll cover them in detail, do not worry. And then we'll talk about some industry analyses. We try to analyze, like let's say, the financial statements. We try to do some forecasting. We do some ratio analysis. We do things like the PE ratio and stuff like that. And then we see, okay, is the earnings quality good? So we'll cover just in a bit about, are there any black swan event? Are there any things that will distort the financial statement? So that's where we assess the earning quality. All right. So today we'll be covering these components, step one and step two. Moving on, we'll go to step three. Step three is where the quantitative component comes in, right? We need to assess, what valuation model do we want to use. So I hope that the DCF, the FCFF and FCFE, I believe you kind of have heard of it before. Is that true? Or is this totally new for all of you? So is the dividend cash flow model, the free cash flow model to firm, or free cash flow model to equity, are these all new for all of you? Heard before? Okay, that's good. That's good. Yeah. Briefly introduce. Okay, that's good. Not really new. Yeah. Yes, that's right. Gordon Growth model. That's true. So the dividend cash flow model is the Gordon Growth model. Yeah. Different names, same idea. So yes, I believe most of you have kind of heard of it before, but we'll dive quite in detail of the various models, and of course do a recap as well. The residual income model might be new, something that you have not seen before, but we'll go through that. Then we might actually do a varying model where we use relative valuation. So basically, these are using market ratios. So to actually value a firm and compare it with a relative firm. And then the idea of it is to, we'll cover 1, 2, 3, 4, 5, about 5 or 6 models. And the idea of it is that why we're covering so many is when we value a firm, is to give you the tools to kind of know, okay, in this case, should I use this valuation model or that valuation model, right? So at the end of the day, you don't have to use all the valuation model. We'll cover 1, 2, 3, 4, 5, generally 5 models. And you have to, kind of pick and choose kind of like decide which one is the best to value the firm that you are given. All right. Okay, so after you choose your model, you calculate using Excel various numbers. At the end of the day, we have to value the firm, right? So we have to say, okay, so based on all the qualitative and quantitative kind of figures that has been given to you, is this a firm that is undervalued, overvalued, and what should we do? Should we buy? Should we sell, etc.? So we complete a valuation. We check what's our client's objective. Okay, so the client wants a 5% return. So when we value this firm, will it give us a 5% return? So we realize, oh yes, maybe give us 6%. But remember, the idea is that if the client wants 5% and you give the client 6%, is this a good or bad thing? Good. Okay, no, okay. So that's like kind of a small little trick question. Yeah. So I see James say depends. That's true. It depends. So the idea of it is that if you value a firm, right? So this can be in your, when you do your valuation report as well. You value a firm and you realize that, after you do your whole valuation, the firm can give you a 10% return, but your client only asks you for 5%. The idea is that it's actually bad and it really depends. So bad in the sense that, remember, we talk about the risk and return. We talk about if we take on more risk, we get more return, right? So if a client wants 5% and you're giving him 10%, means that you're actually doing what? You're taking more risk than he actually wanted. So that's why there's this part about completing the valuation. At the end of the day, you must achieve the client's investment objective. So yes, so maybe the client could have taken more risk. You might be right, but if the client specifically say, oh, I just want 5%, and if you're giving him 10%, means that you're actually taking on more risk than the client really wants you to take. So it's actually bad. So again, if you do read questions or in real life when you do evaluation, you want to try to make sure that whatever you value, at the end of the day, the returns that you'll get matches the objective of your investment objective of the client. So we have a question here. What about more returns with the same volume or risk? Okay, so that's where the efficient market hypothesis comes in, right? That's the first basis that we cover. So theoretically, you shouldn't be able to get more returns for less risk. Theoretically, you cannot do that unless you say that you have some private information, unless you have certain things that the market do not have, right? So that's why that was the basis of why we cover that. And unless you can really say that, you can really justify that you are actually not taking on more risk, but for kind of more returns. But if you realize when you write your valuation report, it's actually very hard to find that, because whatever information you say, maybe you either you have a specific supplier, you have a monopolistic kind of contract. So maybe that one you can still argue. So later we'll maybe talk about economics, about if you are a monopoly, so you have certain benefit, right? Then in that sense, yeah, you can actually get more returns for less risk, because if you're a monopoly, everyone has to buy from you, right? So regardless, you are not taking on more risk. So in that very narrow scope, you can actually have that. But most of the time, as you already know, monopoly doesn't really exist, or even if it exists in very strict conditions. Okay. Excellent questions. And then last but not least, you make a recommendation, you write your opinion. So at the end, should you buy the stock? Should you not buy the stock? Is it a buy call, a sell call? And that's the end of your valuation. So 5 steps. Like I mentioned, step 1, step 2, we'll cover today. Step 3 is the bulk of our next few lectures. And step 4, step 5 is where you bring in your concept from or your summary from the 6 lessons that were covered. Yeah, it could be a whole call as well. So depending on the market conditions, we can actually say that, maybe you should just hold the stock and wait it out. Maybe, when things like, when there's a black swan event like COVID, maybe it's better just to hold rather than sell at a point of time. Yes, could be a cold call. Right, so let's jump into fundamental analysis. To fundamental analysis, basically the idea is that we want to understand what is the intrinsic value of the firm by the public information that's available, and largely it relates to financial statement information that's available about a company, right? And the idea is that, we want to say that, hey, you know what, the intrinsic value is more or less, hopefully it's more than the market value, and therefore you should buy this stock, then you can get a good return, right? That's the idea of it. So generally, if you do a fundamental analysis, the strategy is that you want to do a medium or longer term kind of holding. So fundamental analysis is more, I guess, investment related. Later we'll just cover a little about technical analysis, but technical analysis is more about trading, right? You want to make a fast profit, so that's more short-term related. So for fundamental analysis, it's kind of like an investment strategy where you want to hold it from the medium to long term. All right, so in terms of fundamental analysis, there are quite a bit of things that we need to consider. So we need to consider things like the riskiness of the cash flow. We need to consider what's the discount rate, and things like this can be a bit tricky to put into practice. Like if it's given in like a question, like they tell you, oh, the risk-free rate is 5%, right? When it's given a question like this, we know it's 5%. But once we think about doing a fundamental analysis in terms of valuing a firm, the question now comes, oh, where do I get my risk-free rate? What risk-free rate should I use? Should I use the government bonds? But even government bonds as 5 years, as 1 year, there are a lot of varying kind of opinions what should be used, and a lot of assumptions that you make. So it becomes a bit more fluid, and that's why we have things like top analysts, right? So if you heard like top analysts in the banks, they can always find undervalued firm, so that the firm can invest in the firm in that particular company. So why are there top analysts and maybe not so good analysts? Is that they use varying kind of assumptions, they use different components for their fundamental analysis, and that's where the difference comes in. So of course, you need to estimate what's the future cash flows and what kind of risk-adjusted rates we use. So okay, that's a good question. So medium to long, yeah, I would say 5 to 10 years kind of time horizon. Maybe short term is like less than 1 year or 2 years. There's not really a fixed kind of investment horizon, but generally 5 years is medium, 10 years is kind of long. That's good. So the idea is that if you find a undervalued firm, you want to buy it because you realize, hey, you know what, it's undervalued, right? So you should buy it, and therefore you can sell it for profit. And of course, if you find a overvalued firm, you want to sell. And that's now what a friend of yours mentioned, it can be a hold as well, right? Hold. And of course, you need to justify why you want to do a hold. Maybe because there are some economic events that is happening. So some economic kind of turbulence and stuff. So you just want to hold it. You don't want to do buy or sell. Yeah. So there are actually three options here. So buy, sell, or hold. Okay. So in terms of fundamental analysis, we have two types of approaches. You have the top-down and bottom-up. I like to put it that most of the time, it is a bottom-up approach. Bottom-up meaning what? Okay, let's talk about top-down first. Top-down means that you start off with a big picture, right? So you start off with, like, let's say, economic outlook of a country, or even the world. What's the economic outlook of the world? And then you narrow it down to economic outlook of the country. Then you narrow it down to the economic outlook of, let's say, the industry, right? So from the biggest, the global, to maybe more of the national, and then eventually you go down to more of just the specific industry, and subsequently you go down to the specific country, the company. So in the end, you go back to the company, and that's where that is the one that you want to invest in. So that's a top-down approach, right? So start with, let's say, you see the country, and then you go down to the industry, and then you do the company, and let's say, okay, let's invest in this company. So you go from top down. And this is an example here. So, Asia is a good outlook. And then what kind of industry? Maybe more of the electronics and software industry that's performing well, and eventually decide, okay, you know what, we want to invest in Samsung. So it's a top-down approach. But like what I mentioned earlier, okay, so this is just a, oops. This did not look well, but this is just a pictorial version of what a top-down looks. So the thing is that most of the time, we already have the company in the back of mind, right? We say, okay, I want to invest in Syntel, or I want to invest in Facebook if you are in the US market, right? So the thing is that most of the time, we already have that company that we want to invest in, and we do more of a bottom-up approach where we already know what's the suspected company. We can't say that it's the actual company that we want to invest in, but it's suspect. And then after that, from there, we kind of build in the industry analysis. We build in the competitor analysis. We build in the economic analysis, and then we justify why we want to invest in this firm. And finally, we make a recommendations to say like, okay, let's invest in this firm. So this is more of a bottom-up approach. I would like to say that in most cases, in terms of your assessment, in terms of your kind of reports that you're going to write for this course, it's more of a bottom-up approach where you already kind of identify a company, and then from the bottom up, you kind of justify why you want to invest in this company, right? But in actual, like if you go out to the market to work, or maybe even some of you are already working, and you are in an equity research firm, that's where they actually approach the investment from a top-down approach. So equity investment meaning what? You really have to be knowledgeable about the industry and the developments and all, and therefore, from the top down, you kind of decide what firm to invest in, right? So, but in the case of like this course, in the case of writing your investment reports, you'll be more bottom up approach. Okay, so we have a question here. Does whole equals to perfectly value, close to value, or specific? Okay, so that's a good question. So I would say that it's more of the latter, in the sense that it is due to very specific conditions, market headwinds, you're totally right, tailwinds that are actually affecting the particular industry, or maybe not even industry, but the country in general, right? And therefore, that's why you want to say a whole, to ask the person to hold. Right? Thanks for the question. And so this is an example of top by bottom up in a pictorial version. Like what I mentioned earlier, today we'll cover the three more qualitative kind of analysis: economic, industry, and company analysis. And then lecture 2 to 6, we'll do more of 6 models that we talk about. And basically, item 9 and 10, it's more of just like a summary, pulling everything together, right? Arrive at a value per share and make a recommendation. All right. This is not too important. I'm just going to skip this. So let's think about what's economic analysis in this sense. So economic analysis is, as what you mentioned, we are trying to analyze the economy, right? So we are going from a very global perspective. So we're not talking about industry at the moment, we're talking about more of the economy. So we want to look at things that actually impacts the economy, and what kind of company or the sector that this company is in, that whether it goes together with the economic cycle, or maybe it goes contrarian to the economic cycle. Contrarian meaning that it goes the opposite direction, right? So in a sense that, asset with low expected return during weak economic conditions or weak business cycle trough, you can't have higher risk premium. So this means that what the asset is going with the economic cycle, right? there could be assets that go in opposite direction, and therefore the risk premium would be different. So we need to understand are there any like lead-lag kind of relationship between the economic variables and how the market responds. So there is a good long list of various lead-lag measures that we'll look at. But before that, the idea of like economic analysis is that it's based on a few factors, right? And so hopefully this will remind you of your economic 101 kind of course that now you're putting in those knowledge. So we'll look at first of all like the GDP, right? So the gross domestic product. Of course, your economic professor will tell you a long list of reasons why you shouldn't look at GDP because it's not accurate. Companies can fabricate GDP growth, GDP results, as you see in the market, like in China, they do that. They release their GDP, or the central bank release their GDP growth, which is not reflective of the market, etc. Right? So yeah, there are many reasons why GDP is bad, but in general, if we do an economic analysis, we want to look at the GDP, right? And is because why we are looking at it, because it just gives a very good overview of what's the total value of goods and services that's produced in the economy, right? Of course, you can look at GDP per capita, which is better because you kind of divide it by the population and also it's better. And that thing is that it does not distinguish between seasons and non-seasons. So it's just look at a country level kind of measure, which is what we want, right? Because we're doing economic analysis now. And there are some the main components, consumption, investment, government spending, net export, and these are some idea of what's output gap, actual minus expected, and what's a recession, which is just 2 quarters of successive decline. So as you see here, right, the main components of the GDP, maybe I'll just use a different color, is consumption, investment, government spending, net export. So these are the components that we want to investigate, and we'll see that we want to find out, is there an increase in government spending, right? So is there some fiscal policy, is there some monetary policy, right? Is there some investments being made, or is there increase in consumption, etc. So those are some components of economic analysis that we are interested in. All right, so this part you can just have a look at it. Basically, it's just saying that economic analysis, because it helps you determine how the capital market is functioning. It also allows you to give some relationship, right? So we'll look at some lead relations in a bit. I'll just skip over this. So generally, when the economy is doing well, what we expect, right, for a well-functioning economy is that there's high income, high consumption, high saving. Means what? There's more loan generating due to higher saving, because when people save more, the bank can loan out more money, so it generates more money in general, right? At the same time, there's higher production, of course, lower unemployment, more workers are being hired, and then higher investment back in the industry, and the whole cycle repeats, right? So this is like how a functioning economy works, which you probably already know. And this is an example of a leading indicator. So what's this? So if you look at this blue line here, right, this is the leading indicator. If you notice that as the blue line drops, the red line would kind of drop slightly behind, right? The blue line, so it's a leading indicator. So this is an example of how it looks like. I'm just going to skip this because later I have a better slide for leading and lagging indicators. Maybe I'll just jump to that slide. Okay, so this is the slide that I like to use. So these are examples of leading. These are examples of coincidental and lagging indicators, right? So most of the time, I would say we like to highlight the lagging indicators more than the leading indicators, because leading indicators tend to lead, yes, but at the same time, because they are influenced by changing environment, market information and all, it tends to keep on changing, and then it's hard to determine whether it's a leading indicator or maybe a coincidental indicator, right? So in a sense that we tend to focus a lot on lagging indicators because they kind of are historical information that is already there, and therefore we're able to determine from the lagging indicator what could the economy move in the future, right? So lagging indicators will include things like unemployment. So as you know, usually unemployment lags behind the economy. Yes, the increase in unemployment or decrease in unemployment is a lagging indicator, right? So as more people have jobs, it kind of lag behind the economy. So economy has to be doing well for let's say a couple of months before we see the jobs the unemployment rate decrease, right? So those are lagging indicators, as you can see here. Of course, there's a whole long list. You can look at things like inventory to sales. So generally, as the economy is doing well, the amount of inventory that you have kind of decrease, right? Because you have more sales already. So the inventory to sales ratio kind of gets smaller, but it lags behind the economy. Okay. Maybe I'll just cover a bit on one or two coincidental indicators that includes things like let's say manufacturing and trade sales, because manufacturing and trade sales closely relate to the economy, right? The economy, in the sense that if the economy is doing well, there is more demand for goods and services, right? And because there's more demand, the manufacturing and also the trade volume will kind of increase. So it kind of is more coincidental in the sense that it moves very closely with the economic cycles. Okay, we do have a question. If you want to predict the status of the economy, do we use mainly leading indicator or here? Okay, so that's a good question. Okay, so let's see. Okay, so for the leading, okay, so we use usually a mixture of indicators, right? And I mentioned earlier that most of the time we like to use the lagging indicators because we already have the historical information that's there, and it usually provides us some input in terms of, okay, you know what? Because it's lagging, we kind of already know where the economy will be headed. So we tend to use lagging indicators. If you notice, you look at market reports. However, that's not to say that we don't use leading indicators. We do use things like index for consumption expectation, or even things like your CPI, consumption indicate, which is more reflecting of inflation. So we do use some leading indicators as well. But if you see, we also can use the things like the yield curve. What is the treasury rate minus the federal fund rate. So we do use some of these indicators as well. I'm not sure whether you know things like the bond yield. So we look at the bond yield as well, the government bond yield, which provides some leading indicator information whether the market is on a rebound, when the bond yield inverts. Usually we say when it inverts, means that the economy is going to a recession, right? The yield curve. Yeah, that's right. So there are some leading indicators that we look at as well. Let me just look here. Manufacturing. Okay, so this one we also look at it quite often. Manufacturing new order. So if you look at this, right, this is especially for capital goods. So for capital goods industry, this could include things like the shipping industry, where there's a lot of capital requirement. Usually they like to publish this kind of order, they call it the order book for the company, right? So a shipping company in Singapore, it could include things like Sembcorp. So Sembcorp is a shipping, or used to be a shipping, now it's more diversified, but it's part of a shipping heritage, and therefore they usually post things like order books where they say like, oh, you know what, we have XXX number of new orders for the next 3 years, and this kind of provides some leading information about what their revenue might be like. So that can be kind of like a leading indicator as well. Okay, let's just see what else. Okay, I'd like to see this one, number 9, money supply. So money supply, later we'll talk about it as well in terms of monetary policy. That can be a leading indicator as well, in the sense that we look at what is the government trying to, what is the monetary policies they are putting in place, right? And this will affect, of course, the general economy, whether it's trying to slow down the economy or to speed up the economy in terms of uh, the cycles, right? So we do have another question. Should the lagging indicators should yes. So lagging indicators, because it lags behind, we can actually kind of use the past to predict the kind of the future. That's right. Thanks. All right. Um, so you see, just now I mentioned why leading indicators tend to be a bit tough, or I would say not tough, but you need to be very careful, right? We need to, the idea of the why we introduce various kind of indicators is that we need to use a combination of all the indicators. We shouldn't just use one and say, oh, because the order books of, let's say, Sembcorp is very big. They say they are going to have like 10,000 new ships, right? Because of that, therefore, Sembcorp will be doing very well, and therefore we value it very high, and we should buy, or yeah, should buy, right? So we shouldn't do that, because we need to use a combination of kind of indicators to decide, and a combination includes leading, coincidental, and lagging indicators. And the idea is that because leading indicators can provide some kind of false signal, right? Because as the market change, the leading indicators would change, and therefore, if we only kind of focus on one, or maybe just one or two kind of similar very leading indicators, maybe more like economic related indicators, we kind of might have the wrong recommendation. So there's high variability because things keep on changing, data change, of course, actual versus projected, right? Leading indicators generally, it's we might see things like order books. So order books are projected kind of orders, right? They are not actually actual orders. So it might not actually be accurate, because whatever is projected might change in the future as well, right? So the more deviation from actual and projected, generally the leading indicator tend not to be very accurate in general. All right. Okay, you know what? Maybe let's take a quick, let's say 7 minutes break at this point in time, before we move on to business cycle, right? So let's come back at 8:07, if that's okay. We can take 7 minutes break, can have your coffee, or just go to the washroom. We'll be back. At the same time, if you do have any questions, feel free to type in a quick chat. We can address them after this short break. All right, thank you. All right, welcome back. Hope you had a good break. Went for some tea. All right, so before we kick off and continue on business cycle, so what we have covered so far in terms of economic analysis is just more on the idea of leading indicators, lagging indicators, and how you can actually predict how the economy moves in the future. There are actually pretty good indicators, and I'd like to again say that we should use a combination of them, leading, coincidental, and lagging indicators to kind of address what's the economic outlook will be, right? Now let's look at more idea of a business cycle. So business cycle is more, I would say based on what's written here, 9 to 11 years, right? So it's a large scale thing. So business cycle can be affected by, let's say, black swan event, things like the COVID and all. But in a long view of 9 to 11 years, the business cycle might be like this. Let me just try to draw it out for you. So a business cycle can be like that, right? But in between, if we look at the small details, it can be like there and it go down, but overall it's going up and then down. So something like that, right? So generally it's still it's a very bad drawing, but it's still up and down. But then the thing is that there can be small bumps or dips along the way, right? So business cycle, I would say, is larger in a sense. It's if we're going to put it a long-term outlook, but then in between there can be small ups and downs, right? Like things like COVID, for the 3 years, 2 years, the market kind of dipped a little, etc. Right? So that's what the business cycle is. And it represents the fluctuation in GDP relation to long-term GDP growth. So we're looking at really long-term now, right? Long-term kind of growth trends. This is just more of a definition. Output gap is the gap between the actual and kind of potential or predicted kind of output, right? So there are kind of 5 phases to a business cycle that we want to look at. So it's a little small, but hopefully you can see it on your screen. So there's an initial recovery, early upswing, and late swing business cycle. So initial recovery, I think what's important to take note here in the idea of a business cycle is that hopefully with the characteristic that's described in each cycle, you are able to identify which cycle the business that you're valuing is in, right? So remember, at the end of the day, let's take a step back again, right? At the end of the day, what we're trying to do is that we're trying to value a company, right? So we're learning more of the qualitative tools now. And the idea of why we even learn about business cycle in a sense is that we want to identify, okay, which stage of the business cycle is in based on XXX characteristics. And so from there, we're able to determine maybe something deeper like the industry analysis, etc., which we'll talk about in a bit. All right. So there are some characteristics that we kind of can understand. If it's an initial recovery phase, we need to look at things like, inflation might be falling, short-term rates might be at the lowest. As you know, bond price and interest rates are inversely proportionate, and therefore bond price is the peak and the stock price would start to rise as over time, right? And we can look at things like, remember, unemployment, which is more of a lagging indicator, right? So unemployment might be still high, consumer confidence might still be low, right? But as the initial recovery goes to a more of an early upswing, as you know, when things are swinging upwards, or markets are swinging upwards, unemployment starts to fall, consumer spending increase. Basically, things are even the confidence of the consumer increase and things are on rise, right? And when market is on the rise, generally, stock price will increase, bond price kind of stable, maybe inflation too low, short-term rates remain low as a company withdraw monetary stimulus. So, because the central bank need not support the economy so much more. So stimulus reduce, and therefore the inflation still remains pretty low. All right, so late upswing, these are some characteristics here. Bond price start to fall, inflation start to rise, stock price peak, but it's a bit more volatile, and interest rate remain high, right? So these are the three. We do have this slowdown. So when a slowdown happens, I'd like to highlight that at the moment we can actually consider ourselves at almost like a slowdown stage. So what happens in a slowdown? Let's have a look at it. So inflation continue to rise. Okay, we kind of can see inflation rising, right? It has been rising since a couple of years ago, or not a couple of years, maybe just 6 months or 12 months ago. Short-term rate peak. So we know that the peak of the short-term rates was somewhere early this year, right? So that's where our FD rates peak. So okay, we might be slightly past the slowdown already. Bond price bottom, which was true because interest rate was very high. Bond price was so low, which is one of the reasons why we experience a lot of, not we, but like the general economy, in the US, or experience a few bank failures, right? Because of the bond price. Government bond price bottom, yield curve inverts. Remember, we just talk about that inversion of the yield curve, generally signifying like a recession, kind of slowdown economy, stock price tend to fall, which is kind of true. We see that in the early this year, stock price has been quite volatile, hasn't been a very good market for stocks, right? So these are more things like, I would say, leading indicators that show a slowdown. We can look at things of more lagging indicators where consumer spending on big ticket item decrease. These tend to be lagging, right? Because you don't experience it immediately. And what's interesting, I would like to point out is that something that you might want to consider exploring more is that if there is government stimulus, remember we had a lot of government COVID stimulus, this kind of helps to delay this decline in spending, right? Because when we have the COVID stimulus, people have more money, of course they can't travel, right? Because of COVID, and therefore they have more savings, and therefore because of that, spending still kind of is quite high, I would say, for big ticket items, maybe not for travel, but for things like luxury items, luxury goods, and all. And therefore, this might kind of delay the slowdown. That's why I would say we are experiencing kind of a very delayed slowdown reaction in the market, right? It wasn't like an immediate recession, but there was like a kind of drags, and then if some of you are following the market news now, people are saying like, oh, we're out of the recession. So I was like, no, we are in a kind of like a semi-recession, and also there are a lot of different varied opinions where we are in terms of the business cycle. But generally, if you ask me, I would say we are in a slowdown stage, right? And then finally, if we eventually reach a recessionary kind of business cycle, that is where we have 2 successive quarters of decline. So I want to highlight that this is a technical kind of point, in the sense that it's technical that if there's 2 decline, it is a recession, right? But it might not be so, because there are a lot of other factors that comes to play, whether it's a decline, right? So it's a technical point. We might not be considered a recession, even though there's two consecutive cycles of decline. All right. Corporate bonds, deterioration in credits. So does anyone know what's CDS, credit default swap? Have anyone heard of it? Credit default swap. Yes. Okay, that's good. Yeah. Okay, good. So, okay, so some yes, 1 or 2 no. Okay, so credit default swap is basically what is a derivative instrument where what is being done is that it is a derivative instrument, which is kind of like an insurance policy. How I like to think is an insurance policy. How does this work? In a sense, okay, So like any insurance, basically, if you, let's say, invest in company A, let's just say Capital, right? Let's invest in Capital. But the thing is, you feel that, hey, you know what? The economy is doing so badly. Maybe Capital might actually become bankrupt. Of course, it will never happen, but let's say, hypothetically, Capital is going to become bankrupt, right? And you have that impression that it's going to become bankrupt. So what do? You buy an insurance. And this insurance comes in the form of a credit default swap, in a sense that, okay, you find a swap party, right? You buy this insurance. Let's just make it very simple. You buy this insurance, which is called credit default swap. And let's say Capital really become bankrupt. Then you are being, like any insurance, being protected. So you will receive a payoff, a payout by the credit default swap. And then you get this lump sum, and then you do not experience the loss of your investment in Capital. Right? There's a very, very layman, simple terms of a credit default swap. It's like an insurance policy. All right. So generally, as you would imagine, if the company is getting more and more at risk at becoming bankrupt, what happens? The insurance price increase or decrease? So I repeat again, if the company is getting higher and higher chance of becoming bankrupt, what happened to insurance price? Increase. Yeah, perfect. So in the same sense, your credit default swap would increase as well. And a lot of economists or people that study the market like to follow the credit default swap price, right? So let's say the default swap price of X company, let's say Capital, is increasing dramatically. It means that the market is realizing, hey, you know what, this company is going to fail or has a high chance of being bankrupt, and therefore we should be very careful about it. Right? So this is the idea of a credit default swap. And that's how, as a market participant, we can determine a deteriorating credit, right? So people say, oh, deteriorating credit. So how does it work, right? How do you determine a deteriorating credit? So we look at a credit default swap. All right. Okay, so there are some factors affecting the business cycle. The main thing you realize is that there's consumer business and foreign trade. But if you notice that 60 to 70% of it is attributable to a consumer. So as a consumer, we kind of really influence the business cycle that the country is in, right? Small businesses, of course, they can affect as well. And foreign trade, we talk about net export, general net export, right? What's the foreign demand? Okay. So let's look at two kind of policies, which is important to consider when we think about business cycle. First of all is the fiscal policy and monetary policy. Just a quick check. Is this new? Or have you all heard before? Have you all studied, kind of like economics? Is fiscal policy and monetary policy new for you all? Okay, that's good. Studied before, learned it before. Okay, very good. It's not new. Then it will not be too difficult. So the idea of it is that fiscal and monetary policy generally can impact the economy in various ways, right? At the moment, so I'd like to bring in more like the market context now, right? So at the moment, we are tackling the issue of inflation, right? So government has been using a mixture of fiscal monetary policies to kind of like control inflation in a sense. And the idea of inflation is that we have too much money chasing too little goods, right? So everyone understands what's inflation, right? Too much money chasing too little goods. So that's why higher demand and maybe low supply of goods, right? So that's the cause of inflation. And so there are various ways government try to moderate maybe the supply of money, or they can moderate the certain demand for goods, right? So in terms of fiscal policy, government can increase spending or cut tax to stimulate economy, right? Or they can cut spending or rise tax to slow the economy. So this is what is being done now, right? There is maybe a rise in tax, not really in Singapore. Government tend not to do it because fiscal policy is tend to be more long-term kind of outlook. So yeah, there might be some increase in tax as we see our GST and all, but generally it's not due to short-term shocks in the market. All right, but that can be done. Where if we raise tax and cut spending, basically you reduce the amount of money supply, and therefore economy is slow, right? And then the government increase spending or the cut the tax kind of stimulates the economy. So the idea of a budget deficit is that where there is expenses exceed revenues. So during a recession, a kind of a deficit is very common because there's more spending, but there's not enough revenue being generated. And usually there's usually unemployment benefits will increase as well during a recession stage. Of course, when the economy is doing well, deficit will increase. So monetary policy is what is being employed now. I think it's still ongoing, but like at the start of the year, there's so much talk about monetary policy in the sense of interest rates and money supply, right? So basically, the idea is that if you want to stimulate the economy, we increase the money supply and we lower the interest rate, right? When the economy is low. So when the economy is weak, so you want to stimulate the economy, you increase the money supply, you lower the interest rate, right? When it's lower interest rate, then there's more money in the economy. Of course, our restrictive policy is where you decrease the money supply growth and you increase the short-term interest rates. So this is what is being done at the moment. If you realize that why interest rate had been increasing, right? So some of your maybe has started a bit of investment. You know that stocks have been doing very badly, and there is a call for flight of your money towards more fixed deposit related items, right? So bonds are bad as well at the moment. Anyone know why or roughly the reason? Yep, yep, I can see. Yeah, so increasing interest rate, that's correct. So if we look at the Singapore economy in general, there's an increased interest rate, and when there's an increased interest rate, fixed deposit or like quite money market, right? Money market products becomes more and more attractive because we can still get X return, let's say 10% return, okay, not 10%, but let's say 5% return if we do a risk-free kind of like fixed deposit, right? Compared to if you put your money in the stock market now, you can't really get so much return because the stock market is doing badly. As we talk about, it's kind of like the slowdown economy where you see stock price dropping and all, right? And at the same time, when short-term interest rate increase, okay, there is a effect on bonds. So what happened to a bond price when short-term interest rate increase? It fall, correct? Yeah. So a lot of I would say many banks actually hold on to government bonds or treasury bills. We call it treasury bills. So hopefully this is not new, the idea of treasury bills. So what happened is that when the government increased the interest rate too quickly, right, as part of monetary policy to cope inflation, what happens is that if they increase the interest rate too quickly, the bond price will fall. And when bond price fall, what happens to the portfolio of a bank? The value of the portfolio of the bank becomes very low. There's very little, right? It becomes very low. And therefore, the liquidity of a bank will be impacted, right? So can you see like how the various factors contribute? So because of inflation, government wants to include monetary policy, but however, if they increase interest rate, it kind of impacts the capital market as well because participants of the capital market, such as the bank, portfolio might actually drop so quickly, and therefore they might go into certain liquidity crises, liquidity issues that we have experienced. All right. So that's a good question. This is what happened in Credit Suisse. Let's see. So this is business supply. So I actually have this slide here, which I strongly encourage you to watch. So they have a 1, 2, 3, 4, 5, 6. So there are 6 links. So what included this is that, first of all, it's audio. So it's easy, you don't have to read and stuff. And you can listen to it on your way to school, on the train, and also the first 2 is YouTube. The other 4 is on Spotify. So if you do have Spotify, I encourage you to just click the link, copy and paste the link on your desktop. You should be able to access it. And you can listen to it. The Spotify, I think, is about 30 minutes to an hour. But you can listen to it on the way to school. And the idea of it is that, yeah, for Credit Suisse is a bit more complex in the sense that Credit Suisse was already going through very difficult times in terms of its investments. It made quite a few bad choices, bad investments and all. But I think it more relates to what happened in the US, where there was a meltdown in banks like One Republic or Silicon Valley Bank, where it was actually impacted by having too much bonds, right? There was some impact on Credit Suisse, but it's not really that reason why. Yeah, SVB, that's true. Yeah, too much long-term bonds. That's true, because your interest rate go too high, too much long-term bonds, your liquidity portfolio decrease, right? So, yeah, I would surely encourage you to watch all 6 audio or video. Even the YouTube one is kind of like a audio. You don't really have to look at anything, right? So yeah, it is very useful to actually understand more about this idea of economic analysis, and more importantly, what is happening in our market now. Whether is it a contagion kind of effect of the banking failures, and why hasn't it how is it different from '08 financial crisis? Anyone knows? Okay, so maybe some of you already have the knowledge, but how is this different from '08 financial crisis? Okay, the valuation of a bank and all business. Okay, yeah, maybe, yeah, there is a difference, of course. But what was the trigger here? So I would say that if you look at this video on stagflation, this is very good. But it's very different from '08. So '08 financial crisis, remember it is the MBS. You remember what's MBS? Okay, it's not Marina Bay Sands. This was '08 financial crisis. Yeah, that's right. Perfect. Mortgage-backed security. So, for those who have no idea what is a mortgage-backed security, I encourage you to look at it. A mortgage-backed securities, overvaluation of loan, perfect, yeah, and mortgages. So '08 financial crisis was this mortgage-backed security. And that caused a whole financial crisis. I think it's important to know it so that you have some background knowledge, right? And then what happened now, which is actually 2023, is a mixture of a few things, right? We have COVID, and COVID, yes, impact business and all, but the COVID stimulus actually has a negative impact, right? COVID stimulus. So I'm just going to quickly explain that. The COVID stimulus will increase money supply, right? When you increase the supply of money in the market, what happens? Inflation goes up, right? People have more money. And therefore inflation will go up. And because of that, of various other reasons like the oil prices increasing, we have an issue with the supply chain. So there are various factors, right? So 2003 has different. So oil, supply chain, I put CS, right? Supply chain. So it's a combination of a few factors: COVID, oil prices, supply chain, which result in the idea of a stagflation happening, right? So not an inflation, but a stagflation. And therefore, because of these 3, idea of black swan event, kind of really impacted the banking sector, particularly the US, and therefore caused this bank failures, right? And these are very different from the MBS that we talk about. And the reason why is that MBS, because so many banks actually buy into this MBS portfolio, or not really buy, but actually sell the MBS portfolio. That's why a lot of the banks were actually impacted. Even in the Singapore, right? In Singapore, there are banks that actually sell such a product, I mean, not in the Singapore market, but the US market. And therefore, a lot of banks were impacted by this meltdown in 2008. But if you realize, the meltdown in 2023, in terms of the various banks, did not really impact Singapore. If you notice, it did in a small way, but not so badly. And therefore, there wasn't a large market impact. And this is because of various, the reasons why the meltdown happened. So it's important to actually understand. Okay. Any comments, any questions regarding this? Okay. All right. No, then this is just the idea of a business cycle. Agree. Yeah, that's a good comment. 08 was more of a compliance. Bankers were becoming more greedy. They wanted more money. They kind of structured products that were very difficult to understand for a consumer, and therefore it became it became like a bubble, right? It kept on growing and growing, and eventually it burst. But it's very different from the 2003 kind of issues that we're talking about. All right. So industry cycle. So just now we talked already about the business cycle. We talked about the leading lagging indicators. Now let's talk about the industry. So now we're going deeper. We are talking about economic analysis, right? Earlier. Now we're talking about industry analysis. So from economy, which is like the very wide, we are going narrower. So now we're looking at industry. And when we look at industry life cycle, industry cycle in general, we are looking at more very specific kind of industry. So you really must have chosen industry that you're talking about, right? So is this industry, in the pioneering stage, right? Pioneering, growth, mature or decline stage. So different companies are in different industries, and hence they are in different stages of the industry life cycle. All right. So again, I will not go through like every single detail, like all this. But generally, let's just discuss a little about the industry life cycle, and can just see what are some characteristics, right? And again, at the end of the day, I would like to again mention that in a test, in an exam, they'll then ask you describe the 4 industry life cycle. That would never happen, right? We know that the crux of the module is that we are trying to value a firm, and why we are explaining all this detail is that we want to give you the tools to actually try to identify. Okay, so let's say we want to invest in Syntel. So in Syntel, is it in a pioneering industry life cycle? Is it a mature? Most of y'all should probably already know it's a mature kind of industry, right? Okay, so in terms of pioneer, they can be more like startup kind of business, things like your fintech, things that are quite new and all. And so these are some things that to expect, right? Because we will have, low revenue, high burn rate, they basically burn cash, or like things like Grab, Grab is kind of like the pioneer in the pioneering kind of life cycle, industry life cycle as well. I don't really follow the economics of Grab, but the last I heard, they were still not making profit, but maybe now they are making profit. I'm not too sure. Maybe some of you all know, can actually say, can share. But yeah, so Grab kind of like in the pioneering stage as well. Hard to find financing and very short or no track record. In terms of a growth industry life cycle, this is where there's more demand for the products, there's economies of scale, there's funds. Okay, maybe Grab is here. Maybe it's in the growth stage. Yeah. Then, of course, there's some competitors. Remember, we think about Uber. Uber was being bought over by Grab, so it fend off its competitor that compete against each other. There's some diversification that's going on. If you use the idea of Grab, now I think if you all realize, I think there is like these Grab credits, almost like a small loan where you can pay later, right? So in a sense, it's almost like credit card already, which is quite interesting. So they are diversifying their product. And of course, if you don't pay the credits, you get charged interest. So it's like a credit card. Mature cycle. Oh yeah, there's GrabFood as well. That's true. So it's like Uber Eats, right? So yeah, no, diversifying. Mature, well established. Growth is no longer supernatural or super. Need to innovate. There's some challenges that is being faced, right? So decline, that's where the market is shrinking, the product is no longer in demand to re-innovate. You know. So decline industry, I think one good example would be SPH, right? Singapore Press Holdings, where the printing of newspaper is no longer so popular, right? It's really in a very deep decline now. So the idea is that they really need to reinvent to stay alive. If anyone is following the SPH news, I think there is some movement towards more investment. So they start do like I think real estate, real real estate investments to try to stay afloat, right? Because they know the printing market is no longer there anymore. People don't really want to read like newspapers. Or maybe our parents still do, but like for us, or most of y'all, you don't really read newspaper. Yeah, that's true. There's also not-for-profit structure. Yeah. And I think they also went into real estate and then some kind of what's that? They call it elderly living investment. So elderly living is like almost like an old age home, but it's called elderly living, which is like you don't send your elderly parents there, but it's more like a center for people to age nicely. Put it that way. Yeah. So yeah, there's a need to reinvent itself, stay alive. Okay, so just now we talked about industry life cycle. There's industry type as well. So there are various types. So growth, defensive, cyclical. I think off the back of your mind, you probably already know some of like growth industry. Defensive industry, you can think of things like utilities, more capital goods items. Kind of like manufacturing and things like that, more defensive. Or even supermarkets are very defensive. Supermarket industry, goods and services, those are like more defensive. Cyclical, easy things to think about is like discretionary products, luxury products, automobiles like cars and stuff. When people have no money, they don't want to upgrade their cars. Maybe they want to sell their cars. So these are some industry types, right? So again, at the end of the day, when we choose a company, remember most of the time we will be doing bottom-up approach. When we do a bottom-up approach, we need to identify what kind of industry types the company that you chose is in, right? In terms of industry analysis. Okay, so there's this thing called sector rotation. So the idea of sector rotation comes about more from a portfolio perspective, in a sense that when we try to value single companies, they tend not to be very important, right? Because you don't really have to rotate, because you're only choosing one company. But let's say we want a diversified portfolio. We want to do some kind of rotation of these different companies in our portfolio. Then sector rotation comes into play, where we have to, tilt our portfolio more or less in certain industry, depending on which stage of the rotation the sector is in. So this is an example here where, you know what, if we are at a peak level, we should invest more into like natural resource extraction company. And why? Is because when the economy is doing super well, there's a demand for resources, right? To increase production, there's a demand to for things like oil, and therefore we should invest in natural products. So, when we are on a contraction stage, we should invest more in like things like pharmaceutical, things like supermarket, more defensive industry, right? Whereas 12, we are investing in capital goods. So capital goods like things like very old industry like steel manufacturing, maybe automobile manufacturing, things that will be there and there will be due demand for it. And of course, with expansion, we think about consumables, right? Consumable durables, things like things that are not necessary, things can be like travel and all those are expansion or cyclical kind of industry. Yes, you're totally right. Yeah. So when there is if you are doing a portfolio, you're holding a portfolio, right? So not one stock, but you're holding a portfolio of stock. Yes, every time when the business cycle change, we need to rebalance. And remember, the business cycle is not yearly. It doesn't change every year. It is 9 to 11 years, right? Just now we talked about it. So we don't really have to change so much, but usually try to tilt it over time. And remember, if you want to rebalance our portfolio every time, it's cost. The main thing is cost, because cost will be quite expensive. Remember, to sell your stocks, to buy new stock, there's always transaction costs, which will be involved. And therefore, the more you rebalance, the better it is, because you match the market, right? But at the same time, you need to counterbalance it with the cost of rebalancing, right? So if you are very interested in like portfolio, I think there is a course on portfolio management. Then we will actually go into the mathematics of calculating what is the rebalancing cost, and then we will try to tilt the portfolio based on percentage, and how tilting the certain percentage will cause certain rebalancing costs, and how does it impact the returns, etc. So it's actually quite interesting if you are interested in portfolio management, and it's also a good career if you are looking to go into that direction. All right, so this sector rotation. I hope this is not new. Porter's 5 probably, if you have done strategic management, your professor will have gone into a lot of details of this. Everyone heard of Porter's 5 forces? Yeah. Okay, that's good. That's good. Yeah. I think this is like business 101 kind of thing. So I will not go into detail. There's a lot of details here. In fact, there's a whole slide on this, right? There's like things like ease of entry, exit, rivalry of existing, substitute of products, bargaining power suppliers, competitive advantage, etc. So basically, hopefully you have some time to read through. Again, I want to highlight again to you that you don't have to memorize any of it. There'll be never a question asking you describe the 5 forces and give examples of the 5 forces. No, they'll never ask you that. The idea is that you need to have this idea so that you can bring it in as you write your evaluation report, right? Maybe you say like, example, maybe we talk about Singtel, right? Singtel is a telecommunication company. Let's think about, are there some bargaining power of suppliers, or is there a strong bargaining power of buyers? Okay, so for buyer perspective, maybe there is, because people nowadays can switch, right? They can switch to StarHub, they can switch to I think there's a few smaller ones. What is it? Circles and all, right? Yeah, but for suppliers, maybe the bargaining power can be quite high. This is quite an interesting point. What's for suppliers? What are the suppliers? We need to think of the supplier for Singtel being the supplier of Spectrum. So Spectrum, we'll look at it in a bit. So just put it in the back of mind that you need to think about idea of Spectrum. So I think one of the key pitfalls, I would say, for doing a Porter's 5 forces analysis is not being able to identify the right participants in your firm. So just now we talked about Singtel, right? The buyers are quite simple. Buyers are you and I, they are consumers, right? But the suppliers are a bit tricky. So what are the suppliers of Singtel? And anyone can just I already mentioned spectrum as one of them, which is the most important. Anything else in terms of suppliers? Anyone can think about what are the suppliers of Singtel? Apple, electronic. Wait, remember, we are talking Singtel. So Huawei can be electronic parts, maybe not, right? Why do you need electronic parts for Singtel? Yeah. Huawei, yes, if we think about 5G. So if we think about 5G network providers, perfect. So that's where the spectrum comes. So spectrums are actually considered network providers. Actually, many network providers, not really, because Singtel itself is a network provider, right? So yeah. So you can see now it's a bit tricky. So what I want to highlight here is that Portals 5, I believe everyone knows, but you need to be very careful of what you select as the certain things. And you need to think carefully, right? Things like service industry can be a bit tricky already. Like, what are the suppliers for service industry? So you think of a bank, what are your suppliers? So you should kind of, when you write your report, be very careful. Like if you're thinking about a bank, right? DBS. So what are your suppliers? So you just need to be very careful, right? So regarding back to Singtel, if you want some answers, it's actually this thing called spectrum where the government actually sells certain communication network hertz, right? The hertz as the measure of frequency, the hertz to various companies under a contract. So this contract would be given to the like Singtel or StarHub, and they allow the Singtel or StarHub to use this communication network. Yes, like getting a license, correct? So it is kind of the thing that we consider in terms of suppliers, whether Singtel can actually renew such a license or contract to use the communication network provided by government, right? Or whether it can get new contracts. Because for Singtel to grow, they have to get more and more contracts, right? Cover more and more Singapore. Or I mean, Singtel cover most of Singapore, right? If you talk about smaller players like StarHub, StarHub is quite big, but in order for them to grow bigger, they need to get more networks. Yes, so you are totally right. They have to bid for such a license, and usually what happens is that so it's quite interesting because I used to like I mentioned, do analysis for a bank, and we do analyze these kind of things. And the thing is that they have to outbid each other. That's true. And in order to place a bid, what happens is that usually the company like Singtel, StarHub, they have to approach a bank in order to get we call it a funding, a non-committed funding, where if let's say they win the bid, they have to immediately pay like a deposit, right? So it's like a natural bidding process. Of course, Singtel do not have usually it costs quite a lot, like 10 million or 20 million for this license, right? So of course, Singtel do not have that lump sum money available and ready to place in or put in a bid. So they approach a bank, and then they have to, structure their argument why they need the money. The bank will assess Singtel or StarHub, and then it's like, okay, you know what, we'll give you 5 million. Of course, 5 million is not enough. You need 20 million, so they need to approach a few other banks. They get the full money, and then they can put in the bid. So that's how this works. All right. Just now I saw a comment, whether we will think about pestle, yes. So we need to identify pestle and also SWOT analysis. So I think you probably was thinking about that. Yes. So again, I want to highlight that in a valuation report, you do not, or you should not actually talk about pestle, Portals, and SWOT, like all three. No, you don't have to do it. Right? You choose the best framework that you think works for you, and for your analysis, and supports your analysis. The main thing is to support your analysis of your company, because remember, we are most of the time doing bottom up, right? Bottom up meaning that you really choose the company. We want to now construct a economic or industry kind of analysis that supports our suspect invested company, right? Supports that company that we want to invest in. So it should be we're doing bottom up, so we must choose the framework that supports that, right? So do not do all three. Choose the best one that you think works for you. No, I would say banks are not suppliers. Generally, banks are considered more financial intermediaries that provides like financing, and also no, it will not be considered a supplier for Singtel. Yeah. Um, just now someone mentioned Huawei as a supplier. That is possible because Huawei is one of the top 5G providers in terms of antennas. Whenever we have because so 5G is different from 4G, right? So 5G, you need to have the 5G antennas in order to receive 5G. And because 5G is very short spectrum, right? So because of that, Singtel will need to build these antennas. And I think Huawei is one of the key suppliers of these antennas. And because of that, Huawei can be considered a supplier because if they do have monopolistic kind of control over the antennas, then they can charge whatever they want, right? And Singtel will have to pay for it. So that can be a supplier. But if you argue in that sense, right, of 5G, so you really need to structure, I would say, your valuation report to support your company, right? So if you are thinking of like economic analysis, industrial analysis, let's use the idea of Singtel again. Like, let's say you say, oh, Singtel is a good stock to buy and you should hold for long term because 5G is going to explode. Okay, and then you do an economic analysis on 5G, right? Blah, blah, blah. You talk about why 5G you think is the technology to go in the future, right? After that, then you come in the industrial analysis, like, oh, you know what? However, there are some forces that would impact the bargaining power of suppliers for Singtel. And you think about Huawei and maybe the spectrum and licensing. And that's how you can see you're bringing in first economic analysis, then you're bringing in like more industrial analysis, but then you can back it up again, right? You can say, oh, you know what? But Singtel generally is considered a defensive industry kind of player, right? Because everyone still need telecommunication. It kind of is very stable. So that kind of supports why maybe you should have a buy call for Singtel. Right. So there's some example of how we pull in the various knowledge that we have gained so far. Of course, this whatever qualitative should be supported by a quantitative, which is what we're going to look at in the next few lectures. All right. So everyone is following. Yeah. Yeah. Okay, very good. And then company analysis. So now we go on to more the financial statement analysis. So unfortunately, we will not be going through any of these ratios, but I would say that you need to know them very well, okay, to do your financial analysis. So I hope you still remember what you have learned for accounting class, from your basic finance. That's why just now at the start of the lecture, I say anyone from year one, because if you are, especially for your GBA, I'll encourage you to group. Oh yeah, regarding GBA, a quick reminder to send me your GBA groupings by the end of this lesson. And then if you do not have a group, I'll just randomly relocate. All right. Side note. I'll remind you again at the end of the lecture to send me your GBA groupings. But those that send me, I've already recorded it, so do not worry. But generally, I would like to say that you need to do a very good, let's say, financial statement analysis, right? So in case you are year one and you did not really flag out earlier, I encourage you to try to pair up in a group with some year threes so that you have a good understanding of doing a ratio analysis. Okay, so this is just a quick framework of how you do a ratio analysis. In terms of details, like what does a profit margin mean? What does a gross profit margin mean? I hope you have a good background on that already, because we will not have time to go through. Right? So in terms of a ratio analysis or financial statement analysis, what is important to take note is that, let's see. Okay, so you want to compare balance sheet and P&L items and look at changes, right? So usually you focus at the things that have the biggest change. And then you try to give reasons or try to find out what is the reason for this change. Why does it change so much, or why does it constitute a big part of their balance sheet? Okay. we compare ratios across time. As you know, usually do a 3 to 5 years time comparison, the trend analysis. And also we need to compare it to the types of industry the company is in, right? So we need to compare it with industry averages. And then we bring in the idea of economic impact. Just now, whatever we talk about economic analysis, we talk about the industry analysis. And then we bring context and reason why a change. So what does context and reason mean? It means that you need to bring ideas like, oh, what is happening in the industry? Let's say in the COVID, or let's say the oil price spike, things like that, right? You need to bring in the context of what's impacting the industry. Use of economic analysis. So bring in economic context. Okay, this is important. Comment on one-off exceptional items. I put a big star and black swan events. So I want to highlight that whenever we think about financial statement analysis, we first of all need to look at which years are we doing the analysis for, right? So let's say, I don't think they'll ask you to do this, but let's say they ask you to do an analysis of the company in 2010. Okay, 2010. And the thing is, if you talk about things like COVID and stuff impacting the financial statement, you know you're totally wrong. Like you probably will get 0 mark. Because if you're doing an analysis of a company at 2010, I mean, COVID has not happened. It's not even a reality yet. And if you're saying that, oh, COVID caused the company to decline in 2010, you'll for sure get no marks. So be very cognizant of which year you're doing the analysis so that you bring in the right economic events that are happening at that point of time. All right. There might be some impairment write-off. I hope this is not new. Impairment write-off of non-recurring items. And then and so we need to understand what the impact and how does it impact the balance sheet and P&L. So we need to do some comments here and there. Right? So do not worry. I mean, there are a lot of things to consider. At the end of today's lecture, I've attached a very good valuation that was written by myself on a company, right? If you flip later, I'll show you in a bit at the end of today's lecture slides. You'll see all the various components come into play, a very detailed financial statement analysis, and hopefully, you know, that will be a good reference material whenever you do a valuation of a company. All right. I wouldn't say that's A+ standard, but I think that is a very good foundation, good start if you are still a bit lost on how to do valuation. Right. Okay, you have a question here. Where would you recommend getting data? Oh, that's a very good question. Where will you do that? I'm going to show you in a bit. Would COVID still consider black swan event till today? Yes, you can consider COVID as a black swan event in the context of long COVID, or the long impact of COVID in the industry, in the sense that the industry has not recovered from the impact of COVID. You can actually, if you structure it that way, you can actually say that. However, I think now a lot of people are more talking about things like the war in Ukraine, inflation. So those are more important factors. The monetary policy of governments, right? Are governments going to rise the interest rate again next quarter? Or are they going to hold on to the increased interest rate? Those are things that I think are more pertinent. Like COVID, yes, but not so much now, right? So if you do write your evaluation report, try to bring in more recent context. Things like even the meltdown of the banks in the US and what are the new policies in place in the US market. Right? Those are more pertinent issues to think about. Okay, so this is a summary. Can just look at it. It's a good framework for you. I'll not go through. All right, so we have technical analysis. Basically, the only thing I'll talk about technical analysis here at this point of time is that we are just charting the price movement using various charts and indicators, right, to see the patterns and stuff. Now, do not worry. We have I think half a lecture or full lecture dedicated to technical analysis. So this is just to tell you, oh, there's such a thing, so that you don't get too afraid when you see what's the technical analysis. So basically, it's just do charts, all right? So for example, we have this, if you have your Bloomberg terminal, or even I know all of you have FactSet access. Let me just type it out. Everyone know what's FactSet? Have anyone used it before? I hope yes. Yes. Okay, good. Good. I see one person. Yes. Oh, okay. Yes, some yeah. There's quite a few yes. That's good. So pro tip, I would say try to find someone in your team that has used FactSet. Uh, okay, yeah. Some people say BBG or Refinitiv. Yeah, but I'm not sure whether you have access to Refinitiv. Uh, is there a terminal in school for Refinitiv? I would say Bloomberg and Refinitiv is better, but I know FactSet you can access it on your own like laptop and stuff, right? Refinitiv you have to go to a terminal, and Bloomberg you have to go to a terminal as well. But okay, pro tip I would say that if you have try to team up with someone which has used FactSet before, because this will be so important for your GBA, right? Because they give you a lot of data, a lot of analysis. It's a pro tip. S&P Global, yeah, that's good. I like S&P Capital IQ. It's quite good. Okay, so technical analysis is basically just doing charts and stuff. We are kind of trying to find the trends and all. So I want to highlight, do not worry about this. Do not worry. So there's quite a few things that we talk about here. I will not go through them. Don't worry, because we'll have a session that's going to in detail about what's all this mean, what's a MACD, what is moving average, Bollinger Band, and all. So this is just to let you know that such a thing exists. All right. Okay. So before we move on to the recap in time value of money, let's take in again another 7 minutes break, maybe to 9:11. We'll come back at 9:11. When we come back, I would like to go through. I'll show you the FactSet login, right? Just in case for some of you all have not used FactSet, I'll just quickly show it to you. Um, and I'd like to say it's quite important to be able to use FactSet in terms of doing your valuation reports. And then during the break also, if you have not formed your groups, feel free to try to reach out to your friends to find a group, and then drop me an email later for your grouping. All right. So let's take another 7 minutes break. We'll come back at 9:11. All right, welcome back. So, so I'd like to just quickly show you FactSet in a little, before we jump back into time value of money, which counts as a recap actually. So let's look at FactSet. So for those who are using it the first time, um, this is FactSet. Basically, the good thing, like I mentioned earlier about FactSet, is that you can access it anywhere. You don't have to go to a terminal. You can do it on your laptop where you are. And it's very simple to use, right? So for example, this is what I've been searching. So let's say I want to look at Syntel, right? Just now we've been talking about Syntel. Let's look at some snapshot on Syntel. And I think there was some question regarding how do we find peer comparison or peer the industry averages. So now we're in the Syntel page. There are a lot of information. They even provide you a description of what it is and all. There's quite a bit of information here. Capital market cap, institutional top holdings, etc. What else? What else is important? Let's see. There's some EPS. Oh, they have financials. Also, they have things like EBIT, EBITDA. So if you need to calculate ratios, you can use the figures that's given here. What else? Let's see. Key comps. Can you see key comps? So your key competitors, we can dive deeper to see what they are. So a lot of them are actually overseas. But let's say if we want to look at things like let's see, comms. Let's go to comms, right? So if we go to comms, it's a communication. Let's say we only want to target industry. Okay, not all regions. So that's where you can see StarHub comes in, they tell you what's the price, EBIT, what's the capex. If you notice actually in Syntel, if you are talking about communication company, you definitely need to talk about capex, right? Capital expenditure, because that is their main expense. So we need to talk about that. What else we can look at the entity structure. So this is important as well. Where StarHub is, Syntel is, I think there's this thing called job revenue, which is quite interesting because we can see that actually Australia contributes quite a bit of revenue to Syntel, right? It's not Singapore. Australia is the bigger one. So Syntel actually own Opus in Australia. So their market in Australia is quite big. There's some small Germany, US and stuff. So it's quite interesting here. What else we can look at? There's some financials. We can look at key things of the financials. When you want to do a financial statement analysis, we can do that. So it gives you the various financials. There's some ratio analysis as well. So, the good thing about FactSet is that they do everything for you. But I want to just highlight to you that, yes, you can use the figures there, but please make sure that you know how the figures are being derived, right? Because sometimes they use they do a lot of adjustments to their figures. So if you do not know what are the adjustments, then you might be able to you question yourself, why are you getting this answer when someone else getting another answer, right? So just be very careful when you want to use the figures here. Make sure you know what adjustments is being done, right, to your figures. But you see, everything is being calculated here, right? So, at the end of the day, I would say in terms of value and company, right, most of the time, even your assessment, your reports and all, the test is not about to ask you how to calculate the ratios, right? Because everything can be just gotten from Bloomberg, FactSet, S&P Capital IQ, etc. The idea is that how do you actually value add in terms of the analysis, which is important, right? Okay, so there's this thing called document search, which is quite interesting. We can do a search on the research tab. So for Singapore companies, unfortunately, there's not too much information on the research component. But let's say if you want to do things like Walmart, right? Let's quickly look at Walmart. You know what? Let's just do the last 3 years. If you notice, there's actually quite a bit of research report and even valuation of Walmart that has been done. So I actually encourage you to have a look at FactSet, to actually look at some of these reports that have been done. Because I would say if you are new to valuation, the best way to learn valuation is to adapt your valuation ideas from the analysts that are already doing the valuation, right? The best way to learn is to copy in the first, if you want to put it that way, to copy first, right? Then you can learn from there. So I surely encourage you to, of course, not copy, because you shouldn't copy, but to look at what is being done here, right? See, they did all these ratios, oops, that has been done, and to learn about what is being done, right? Any questions for FactSet before we jump back into time value of money? So again, I'll say that try to get someone with some FactSet experience, or if you don't, I think it's not a very difficult website or platform to use. So it's consumable, non-cyclical. So they even categorize it for you. So whatever we talk about.
This is Luqun. I have a question on this FactSet. How does this data derive from? Who provides such data?
So it's the FactSet team itself. So this valuation report is not by FactSet, it's by the contributor to the various contributions from the various other companies. But for let's say if you look at the company securities and stuff, those are provided by FactSet.
So the team, they got it from like SGS, something like that?
Yeah, so usually they get it from
the annual
financial
reports.
report. Yeah, correct. The annual reports, the let's say, what's that? Revenue announcement, earning announcement. They piece together all the information, right? And then that's how they get all this info.
Okay. All right. Thank you.
Yeah, most welcome. Of course, they also have their own models they run. So like they have a standard way of calculating the ratio. So they have their models already. And so they run the models and then they just plug in all the information that they ran in the models into this platform. So again, I want to highlight that their models usually have certain assumptions. So when you use FactSet, you need to be very careful, understand the assumptions being used before you use the numbers, right? If you're unsure, I'll recommend you to just take the raw numbers meaning the numbers from the financial statement, and calculate them yourself in terms of the ratios. But if you understand the ratios being used in FactSet, feel free to use it, make sure you cite accordingly, and then explain accordingly. All right. Yes, the account is free for all students. I think you have to do a registration, then they'll give you a login, and otherwise entirely free. All right. Okay. Let's just quickly jump back into time value of money. If you have any questions with FactSet, feel free to type it out. I don't think you have to show the calculation. You can put it as appendix in the Excel file. In case you are doing some more complex manipulation in the data, but if it's very standard things like net profit margin, right? Net profit divided by sales. If you're doing nothing too complex, you don't have to do it. But if you're doing things like you're doing adjustments, you're removing impairment because it's a black swan event, okay, then those you should put in the details, right? Yeah. All right. So at this point in time, we have actually kind of covered what we want to cover. This last portion now is just a pure recap. If you are really very good at time value of money, and if you need to rush off, feel free to rush off, or you want to sleep stuff. But for if you want, this will be a good recap, because time value of money, I would say it will be very important for your valuation models, right? So these will be the basis of your valuation models. So understanding the basic of time value of money will really help you when we go on to lesson 3, 4, 5, 6, or even actually lesson 2 weeks time. Okay. So again, this one I'm going quite fast because I'm assuming of course everyone has done time value of money. And this is just a recap. All right. So again, when we talk about time value of money, we always only focus on compound interest. So we are never considering simple interest here, right? So just throw simple interest out of your mind. And when we talk about compound interest, it's interest on the principal and the interest amount. So I'm not going to go through this. So actually, these slides are from your FIN 203. So I taught that for a couple of years. So yeah. So I actually just put in the slides in case some of you would like to do a recap on yourself as well. So the idea of this is that the power of compounding is if we use compound interest, we get this amount. If we get simple interest, because we're just multiplying just 10%, 5% times $10 times 200 years, right? We only get $100. So the power of compounding is quite a bit, as you can see here. Right, so I'm going quite fast, so do not worry. Of course, if any question, feel free to stop me. This is important, I would say. Number of compounding periods, you have to be very skillful in terms of understanding this number of compounding periods here. So if you do semi-annual compounding, make sure that you divide your rate, because remember this rate is called, we'll cover this in a bit. This is the nominal rate, norm, R norm. N-O-M, not M. Yeah, NOM. So you need to, because semi-annual, you need to divide by 2, and then number of periods must times 2, right? Monthly, you need to divide by 12, and then this one you need to times 12. Daily, 360, right? So just take note. Don't worry about continuous compounding, we will not be using this. Okay, so this is an important part where we need to be able to identify the type of rates, because rates sometimes can be very confusing after a while. So whenever we talk about the APR, or annual percentage rate, that is the nominal rate, right? And most of the time, when just now you notice when we are doing the divide and all this, like when this 10 divided by 12, 10% divided by 360, what we are calculating now is actually the periodic rate. So it's the nominal rate divided by the number of periods. Now, the thing is, what is that? Okay, so there are a few questions here, right? So what is the APR or nominal rate if monthly rate is 5? So this is monthly rate. So this monthly rate is the periodic rate. Okay, it's the periodic rate. And if it's the monthly rate, you just times 12, then you get the nominal rate. If it's a semi-annual, you times 2 to get the nominal rate here. Now, if we have a monthly rate of 12%, which is what's the monthly rate if the nominal rate is 12% with monthly compounding? So remember, when we calculate what is the periodic rate, we just take the nominal rate divided by the number of periods, right? 12, which is 1% here. However, can we take this same rate divided by 2 to get the semi-annual rate? This is a big no. This is very important. You cannot do that. You cannot do this. Yes. So those that say, yeah, thanks for saying no, because if you say no, that means, yeah, you know your time value of money. You cannot do that, because if you want to do that, you need to get your nominal rate based on semi-annual compounding. Yeah. So this is the part of rate that can sometimes be very confusing, right? Some people are like, oh, how come this rate you can divide by 12? How come this rate can only divide by 2? Because it's based on compounding. If you have your nominal rate based on monthly compounding, you can only divide it by 12. But if you want a nominal rate based on semi-annual compounding, then you need to get this rate, then you can divide by 2. All right? Everyone clear with that? Any questions for rates? Anyone want me to repeat? I'm happy to repeat again. So for now, okay. Remember, feel free to let me know if you want to repeat. Effective rate. So this is also important because when we are calculating or when we're comparing valuations of companies with different time horizon, we need to calculate effective rates. So effective rates basically is what is the rate if it was as if one year, right? One year. All right, so you use the EFF Excel formula. Do not worry about this because you will never calculate this by hand. We just use Excel, and we just use this effective formula here. EFF is T. So we plug in the formula basically. If this is the nominal, and we know it's a daily compounding, we just plug in this as the nominal and number of days, and we get the answer here, right? So never use the manual method, just use Excel. If we have a semi-annual compounding, we plug in the figure here, and then no semi-annual is 2, right? So we just put, we just put 2 here, and then we can get what is the effective rate. Okay, so the use of effective rate, I want to say, is never to calculate time value of money, right? Usually effective rate is only used for comparison. Okay. Okay, so this is going back to the basic of time value of money. There's future value, present value, and these two are the most important. Actually, present value more important than future value. So future value is what is the investment 3 years from now, right? What's the value of this investment? So this one I'm going a bit faster because later I'll focus more on the perpetuities. I think that's more critical for the next few lectures because we are using the idea of perpetuity more. Okay, so future value is, you have $100. Sorry, you have $100 here. What's the future value after 1 year? Future value after 2 years? After 3 years? So it's just compounding that value, right, over a number of years. You can use this formula, but you never use this formula, so you just use the equals FB in Excel, right? So I'm not going to show you how to use it. I presume that you already know. Yeah, to use the FB function. Everyone or anyone needs me to show you how to use it in Excel. Future value. Okay. Okay, so this is the part I want to highlight to you here. Timing of cash flow. So even sometimes you might have already did your course on time value of money, but you might actually forget this. The convention is very important. Okay, so how I like to always describe it in my course when I teach 203 is that imagine money going in and out of your pocket. Okay, so imagine the money going in or out. So when the money is going into your pocket, it's a positive. Money is going out of your pocket, it's a negative. This is very important because we'll be calculating things like rates. Because later we need to calculate the return on cost of equity, and we need to use the rate function in Excel. So the convention becomes very important. So again, I repeat, if money is going into your pocket, it's positive. Money is going out of your pocket is negative. We have some examples to show you in a bit. All right. So we have the present value. Basically, just inverse the formula. Basically, the idea of present value is more important because most of the time we want to calculate what is the value of, let's say, the company now, right? We're doing valuation. Remember, we're still doing valuation. Okay, so we have this example here. How much would 103 receive next year worth today? So this is quite easy. You just calculate present value. All right, so there's this another example. We just bought a new computer for 3,000. The payment is due in 2 years. You can earn 8% of your money, how much money should you set aside today in order to make payment due in 2 years? Okay, so in this example, your FD is negative 3,000. Okay, why negative? Because in 2 years' time, you are going to pay, right? You're going to pay. Payment is due in 2 years. So it's a negative. Money is going out of your pocket. And the idea is that you want to calculate what's PV, right? PV is the question mark here. So N is 2. What else? We know that I slash Y or interest is 8%. And if we put this into the into your Excel formula to calculate PV, we should be able to get this, and your answer will be a positive 2572. And why is it positive? It's because you have to have the money in your pocket and of this amount today so that you can pay, meaning money going out of pocket, the negative 3,000. Right? So that's where you see the negative and positive becomes important. So it's not random. It's not like, oh, sometimes I put negative. Why? Sometimes I just put negative for FV, sometimes I put negative for PV and all. So always reference it to your pocket. All right. So we have this question here. Suppose you want to borrow 200,000 pesos for 1 year. Interest rate is 12%. You and your lender agree that interest on the loan will be 24K. Okay. So the lender deducts the interest amount on the loan upfront and give you 176,000. What is wrong here? Okay. Before even doing the calculations, right? Anyone can tell me what's wrong? Like, what's the issue here? Yeah, why upfront? That's good. But actually, this is very common in banks. If any of y'all have started working already and planning to take a bank loan for your house and stuff, the house maybe not so they will do that, but other kind of loans, right? They actually do this for your loans. Yeah. So house usually is amortizing loan, so it won't happen. Okay, so why they deduct upfront? So what's happening here? Let's do a calculation. So PV, what's your present value? You are getting money in, right? 176,000. This is the only thing you get. FV is what? You have to pay then 200K, right? You have paid in the future. N is what? Number of years is 1. Interest rate IY equals to 12%. Remember in Excel, you have 12%, you have to convert it to decimal. So 0.12, don't put 12. What happened when you calculate this, right? Sorry. No, you don't put. You are calculating IY. You are calculating interest. So you don't put interest. Yeah. Yeah. So your IY, when you calculate question mark or your rate, is actually more than 12%. That's true. That's correct. Yeah. Yeah. Need add the loan. Yeah, correct. So you're actually paying higher interest. I think the answer is around 13%. If you calculate it on Excel. Okay, it's around 13%. Higher interest. So instead of paying 12%, you actually pay 13%. So this is wrong. Right? So in case any of you are going to a bank to take a loan, just be cognizant about this, because sometimes bank does that, especially retail banking. They like to do this, right? But after this course, you should straight away know, like, hey, you know what? Why they do this? Then you straight away tell the banker that they are charging you more, and maybe they can give you a better rate. All right. So interest rate, there are various things that we'll talk about in the future: cost of capital, exchange cost, rate of return. So they are the same thing, just different terminologies. This is just an idea of time value of money. So as like what I mentioned earlier, I like to give a very bird's eye view first, right? So the whole idea of time value of money, right, is that money at different points in time is worth different amount, right? So I repeat again, money in different points of time is worth different amount. So the idea of it is that you want the money now rather than the money later, right? Because the money now worth more than the money later simply because you can invest the money, can do things with the money, and make some returns, right? So whenever you are shifting money from different points in time, right? This is quite theoretical in the sense that obviously in real life you cannot shift money, right? But in a theoretical perspective, you are shifting money from year 2 to year 1. Whenever you want to shift the money, right, you have to calculate present value. You have to consider the rate of return, blah, 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 and discount it, right? So whenever you shift money back in time or forward in time, you have to use PV or FV respectively, and you have to consider that. So this is something you put in your back of mind. Whenever you shift money, you shouldn't, the $100, 3 years shouldn't be go to $100 received now. Okay. So you should be able to understand this. Receiving, should you prefer receive 1,000 today or 1,000 1 year from now? Anyone? Which one do you prefer? Today, yes, correct. Yes, you want today. Yeah. Yeah. Because you can invest the money. Yeah, perfect. Okay. So some implications, stock valuation. This is the main thing that we'll talk about for this course here. Okay. I'll not do this. You can have a look at it. Suppose discount rate. Okay, so that's FV and PV. So now we're talking about multiple cash flow. So I am multiple cash flow. And if your cash flow is changing, right? Remember, we can use this thing called the NPV formula, net present value. So let's look at this example here. Suppose you have a dealer that gives you, 15,500 cash now, or they can give you 8,000, 4,000 in the following 2 years. Cost of money is 8%. Which option do you prefer? Option 1 or option 2? So remember, when we do this, we should use a Excel, and we can basically put the cash flows here, put the cash flows 8,000, 4,000, 4,000, right? 8,000 now means period 0. Okay. And then we calculate what's the PV. Of course, the PV for 8,000 is just 8,000, right? Just 8,000. But the PV for these two will be lesser, right? Because we discount it back to present. So we use a sum, we can calculate that. So this is one method using the PV formula. Or let me just erase this. It's a bit. Or let me just put the smaller. Okay. Or we can do the NPV formula, right? So this NPV formula. So for the NPV formula, I want to highlight to you that you should not include the cash flow at year 0. All right. So can you see here R4? You should not include cash flow at year 0 in your NPV formula. You should put it outside the NPV formula. All right. This is a very important point. When you're using NPV formula, you always start only from period 1 because they will do the discounting as if the first period is period 1. Okay. There's one point I want to highlight to you in your TMA or your ECA, GBA, right? Is that whenever you do a copy screenshot of your Excel, this is a very bad way to do it. In a sense that, can you see there is no reference here? So like, imagine if you are supposed to read R5, R6, but there's no way for you to determine where's R5, R6. So this is bad. This is bad. This is very bad. So you must include the columns and row numbers and alphabets, so that like when you're doing the referencing, the marker can actually say, oh, okay, this is from where, this is from where. All right, this is important to take note. Okay, sure. I can repeat. I think somebody wants me to repeat. So for MPV, let me just erase this. So for MPV formula, using this MPV function means that MPV in Excel, your MPV formula, the first cash flow should be starting from year one. So R5 to R6 basically is these two here. They are taking in these two here, R5, R6. And they plus R4. They plus R4. R4 is the 8,000 that is here. So the NPV formula assumes that the first cash flow is in year one. So you do not count year zero. Yes, that's true. You do not count year zero. Your year zero must be placed outside the NPV formula. All right? It cannot be inside the NPV formula. Yes, there can be cash flow at year zero. In this case, you can see here, you are getting 8,000 in year 8,000 now and 4,000 in year one and 4,000 in year two. So yes, you can get cash flow in year zero. So there is cash flow in year zero, just that in the NPV formula, they will only start discounting the cash flow by treating the first cash flow at year one. So in the formula, you must start with year one. Okay. So this is an example, again, using NPV formula. So a broker calls you and tell you that he has a great investment deal. You invest $100 today, you receive $40 in 1 year and 75 in 2 years. Your required rate of return is 15%, I'm sorry. And should you take this investment? So can you see that you have year one, year two? So year zero have no money, right? I've done up the cash flow for you here. Year one, you get 40, year two, get 75. I'm using an MPV formula for this figure here. And my formula is I get my MPV or my present value as 91.49. For this case, I do not need to consider year zero because year zero, there's no cash flow, it's zero. So at the end of the day, should you take this investment? Anyone? Yes, no, right? Because you are getting $91 by investing $100. So of course, it's quite normal because they have to charge you admin fees. Okay, so what I like to get at is this idea of perpetuity, which is very important, I would say, in the next few lectures, because you need to have the idea of perpetuity very clear. Okay, so when we have a perpetuity, so what's a perpetuity? Perpetuity means that the cash flows goes on forever, right? So there is no end to the cash flow. Now, in all perpetuity formula, whether it's a growing perpetuity or a standard perpetuity, the cash flow C always starts 1 year from today. So this is a very important part, 1 year from today. Of course, in a perpetuity formula, it's not important because your perpetuity is constant, right? But you will see the difference in a growing perpetuity. Everyone understand this point? In a perpetuity formula, your C, the cash flow, is assumed to be 1 year from today. Okay, yes, only because the MPV in Excel has that function built in that it considers 1 year from year one. That's only Excel. If you use financial calculator, they have different kind of formulation. So the MPV is just because of Excel. All right, but this perpetuity is like this. So for example, you have this government perpetual bond. All right, you're getting £15, right, non-stop. So how do you calculate the present value of a perpetuity? You take 15 divided by this. So I want to highlight why is perpetuity important is because, first of all, there is no way to use Excel. There's no function. There's no perpetuity function in Excel. There's PV, FV, right? So that, but for perpetuity, you really understand the formula. especially later, because we'll be doing a lot of manipulation in the perpetuity form. Okay, so this is one of the key examples I want to highlight to you of perpetuity. And if you understand this, it will really help you in the next few lectures when we talk about valuation. Okay, so let's try to dissect this example. Looks rather simple, but it's a bit tricky. So in order to create endowment, which pays 100K per year forever, how much money must you set aside today if the rate of return is 10%? Okay, all right, very simple. First payment starts 1 year from today. Okay, so you know, I'm just going to, you have your slides in front of you. I'm just going to quickly jump into my notes here. Let's just draw some timeline for you all to understand this. 0, 1, 2, 3, maybe 4 as well. So wait, let me just quickly look at this thing. So it's so 100K per year forever, and first payment starts 1 year from today. So 100K, so you get 100K here. I just go to 100 by in thousands. Correct? Everyone understand this, right? You're getting 100, 100, 100 forever and non-stop. So the question is, how much you pay for this investment? Basically, this is a perpetuity, right? Everything goes back to year 0. And since it's 1 year from today, and remember I told you the important thing about the perpetuity formula is that it must be 1 year from today, which is fine. You have met the conditions of a perpetuity formula. So you just take 100K divided by, what's the return? Is it 10%? Let's see, what's the return? Yeah, 10%. So divide by 0.1. Thank you. Yeah. So this should be the answer. Okay. Sorry. Okay, let's see. Okay. So the first part, I think it's pretty simple. Now let's look at the second part. The first payment, what if the first payment starts 3 years from today? And then you're still now being asked to calculate how much money must you set aside today. Okay, let's jump back into the this part here. So let's now draw another timeline. So 0, 1, 2, 3, 4, 5, 6. All right, so the payment only starts 3 years from today. So when does it start? In year 3, correct? So year 3, 100, 100, 100, 100. All right, and this is a perpetuity as well. Okay, so what happens now? If I'm going to use the perpetuity formula, okay, this is the important part. In case you're falling asleep, this is important. Wake yourself up because too bad your classmates are not beside you. If not, they can wake you up. But wake yourself up. So what happens now? Remember, perpetuity formula is 1 year from today, right? So I'm just going to put, where is 1 year from year 3? It is in year 2, right? So if I'm going to use the perpetuity formula, they are going to discount all my cash flow to year 2. So what's happening? So I'm going to put 100K divided by 0.1, right? It's the same thing. But I'm only going to do it to year 2, all right? Because that's the perpetuity formula here. Now, what's happening? After I do this, you realize what I have to do. I have to, because you want to find what's the present value, right? Present value, of course, is year 0. So what do I have to do? I have to discount this amount here back to year 0, right? So I have to use a PV formula, right? Use a PV. So there's 2 steps now. First, you use a perpetuity to discount it back to 1 year from today, which is year 2, right? And after that, you use a PV formula to discount it back to year 0. So basically what you do, you take 100K divided by 0.1, which is what you calculate using the perpetuity formula, divided by 1.1 to the power of 2, right? Because you are discounting back 1, 2. Yeah, perfect. Yeah, all right. So now you understand why I mentioned that it's important to know that perpetuity formula occurs 1 year from today, right? So there's 2 steps here. So you need to first use a perpetuity formula to get the present value of the perpetuity. After that, you need to discount it back by 2 periods. Perfect. Everyone got this? Because we'll be using this concept later when we do 2 steps valuation. When the stock price change in the middle, then we need to use perpetuity, and after that, we need to deal with the second discounting. If you are very clear with this, right, in the subsequent lectures, when we talk about 2 steps, even three steps valuation, if you have this very clear mindset, you will be able to handle the questions. All right. Any questions at this point of time? Okay. Let me just jump back into the slides. So you should be able to get this answer. Feel free to verify that it should be good. Okay, so now that we just now talk about perpetuity, next we need to talk about growing perpetuity. Again, this is a very important concept because we'll be using this idea of growing perpetuity quite often, I would say, in next few lectures. So growing perpetuity, the thing is that the cash flow is growing at a rate of G, right? So G. And then we need to be able to calculate, again, the cash flow starts 1 year from today. So it's the same concept, 1 year from today. So, we have this, so 1.3. So dividends next year, which is 1 year from today, is 1.3. And then we can calculate what is the PV using a growing perpetuity in this case. And a growing perpetuity is used to calculate the Gordon Growth model. I think most of you all have heard of it. Just now I mentioned Gordon Growth model or dividend growth model. You have all heard of it. So they use the growing perpetuity formula because your dividend is growing at a certain rate of G, right? So how do you calculate the stock price? So this is a recap again on this idea of using a growing perpetuity to calculate stock price. P0 stock price or firm value equals to your dividends in year 0. That means dividends now multiplied by 1 plus G divided by the R minus G, right? So what we need to be very careful when we read questions, right? Suppose Big D Incorporated just paid. So what's just paid? Is this D0 or D1? Yeah, very good, very good. Most of y'all identify as the D0. So we need to remember using a perpetuity formula, growing perpetuity, we need to consider D1, right? So we need to take 0.5 times 1.02, which is the growth rate, divided by 15% minus 2%. Right? So this should give you the stock price. Yeah. Good. Good that everyone can see that it's D0. Perfect. Ordinary annuity. So now, the thing about perpetuity is that the cash flow is forever, right? But an annuity has only cash flow up to 5 years or 6 years or 10 years. So there's an end to the cash flow. So we can use this ordinary annuity formula, but we'll never ever use this because we can just use Excel for this, all right? So if it's just 3 years, we can actually calculate the cash flow. So these cash flows in Excel, we will put it under PMT, right? Payments in our PV formula. Again, there is an important part that it has to be 1 year from today, but it is not so critical, as in not so critical in the sense because you can use the NPV formula and all, right? So yes, it's important to respect the 1 year from today as well. So you'll never ever do this because you have Excel now. Basically what you will do is that what's the maximum car loan you can take for an interest rate of 5% for 7 years. So you have a monthly payment, right? So now we can see that let me just erase this. So now we see that so what's the maximum PV? So we have PMT, you can afford a car payment of -1500. Remember, you're making money out of your pocket, negative, right? Your N is 84. IY is, so this 5%, take note that this 5% is your nominal, right? So you need to calculate your periodic rate. So it's 5% divided by 12. I hope everyone knows this. So this is where we went back to the rates, right? Let's not say that it's important that you need to know what's nominal and periodic. So you need to divide by 12. What else do we need? We know that we basically need to calculate what's PV, right? So FV, you can put it as a 0 as well. It's not so important. So your PV is the question mark, which is what you want. Okay, everyone all right with this? Okay, so this one I'll let you go through by yourself. Just some examples. Annuity due, again, this is not too critical in the sense that just in Excel itself, again, you'll never ever use this formula unless it's a growing annuity due, all right? But if it's just a normal annuity due, you just simply put the type as 1 here, beginning of period. So annuity due means that the cash flow happened not 1 year from today, but the cash flow happened at year 0. So it shifts the cash flow down like that. All right. Again, I repeat, for annuity due, you'll never use this formula, but it's important to take note what has to be changed, which is this, because if it's a growing annuity due, there is no Excel to do it, and therefore you need to know the formulas, and you need to multiply by 1 plus R. All right, so just now we're talking about growing annuity already. Unfortunately, for anything growth, there is no Excel, so we need to calculate using this formula here. There is a simplified formula, which is this. It's the same thing, just that the cash flows are growing now. And remember the difference between perpetuity and annuity. That perpetuity is forever, it's non-stop. But for annuity, it is like the cash flow is for 5 years, 3 years. And in this sense, it's growing as well. Okay. And this is an example of growing annuity. All right. So that's actually all that we have today. So if you notice, is for time value of money, it was just a very quick recap because it's actually what's been covered. Just wanted to recap because these are fundamental for the next 5 lessons. So if you notice here, which is why the extra slides comes in, is that you have a lot of extra slides. These are just examples of time value of money. Feel free to do it, but I want to highlight that in this course, you'll never ever be asked to do questions like this. They'll never ask you, give you a time value of money questions and ask you to solve time value of money. No, they'll never ask you to do it. It's just purely for your own understanding, right? So if you are very certain in time value of money, you don't even have to do this recap, right? But if you want to just have a practice, I have provided the solutions with the Excel formulation on how to do it, and you will tackle things like the different time periods and the negative and positive, the money in, money out kind of thing, right? So you see why it's negative and all. So these are example for time value of money. There's quite a bit of it. Again, I'd say do it if you need some recap, but you'll never be asked to solve questions like this. Now, this part is more important on the self-review for valuation example. So we have not covered all the tools in terms of quantitative tools, but I have covered most of the qualitative tools for valuation. So this is an example. I apologize in advance because this Breakfast Medical example was given in the original lecture slides. That's why the quality is not so good. If you can't read it, try your best to read it if on the computer, so it's easier. And it provides you the valuation. All right. Overview, Porter. So this use Porter's 5, substitute, etc. But because I noticed that the example is a bit blurred, some of you might not want to read it. You can read the example that I provided here. So this one is what I've done, a valuation example. So there's exactly summary, I talk about what's the company objective. For this case, I use a SWOT analysis. So you can do that as well. You can do a pestle and, or even a Porter's 5. So there's a comparative advantage. I talk about that. Financial statement adjustments. Remember, we talk about black swan event, things that might affect the company's valuation. So these are some adjustments that I have done to the financial statement, which should be explained. All right. And then there is the idea of peer selection, so peer comparison. Like just now, somebody are asking, how do you find the peers? So you can use FactSet to do it, and then of course you need to do a valuation or how you compare with the peers, right? What I want to highlight here is the financial statement analysis that has been done. So I would say this analysis is generally quite representative, is quite good. You can use this example of how you should be crafting your financial statement analysis. All right. So these are some things, balance sheet. So it's quite comprehensive, I would say. Then we talk about some cash flows as well, some financial management, FX risk, And then finally, we have relative valuation, which we'll talk about. We have not discussed what is this, but we'll talk about this in the last few lectures, right? Relative valuation. And then finally, we have at the end of the day, remember your recommendation, right? What do you want? You want to buy, you want to sell, you want to hold. So that's your recommendation. So this is the end. All right. So that's about it. And then these are some appendix that I have included for you. So that's about it for this lecture. I know it's a bit heavy, but remember this more of the qualitative part. You have not learned everything yet in terms of that valuation report that I've just showed you, but I think it's a good start. You can start reading, I guess, the first few components, right, before you do the picture valuation. All right. Any questions? So we won't be having any lecture next week, and we will be coming back the week after. So you do have a bit of time to look through the self-reviews. At the same time, I want to remind everyone again to send me your GBA grouping by today, so that I will send out not email, but a notification on your groupings on Canvas, your confirmed groupings. And again, if you do not have any group, don't worry. I'll just allocate you randomly, and you'll for sure have a group. Right? I encourage you to reach out to your group members as soon as possible to make sure that they are all in this course, because there might be people dropping out and all. So you do not want to run a situation where in their group is only 2%, and then you'll be struggling to do the valuation, because I feel it's a bit of work that has to be done. Right? So that's all. Thank you. Any questions before we call it a day? I know it's a bit late. No questions. Okay. Yeah, thanks for your time. None. Okay, so feel free to email me if you do have any questions regarding Canva money. You need more practice as you review the slides. And yeah, have a great evening. Bye bye.